If you thought California condos were the safe way into real estate, 2026 is forcing a reality check. For years, the sales pitch was simple. If a detached home felt impossible, you bought the condo instead. You accepted the shared walls, the smaller footprint, and the monthly HOA fee because the trade-off seemed worth it. You still got the zip code. You still got the lifestyle. You still got a chance to build equity in one of the most expensive housing markets in America. But now that formula is breaking down because today, buyers are not just looking at the purchase price. They are looking at the full monthly burden. Mortgage rates are still high enough to hurt. HOA dues keep climbing. Insurance pressure is moving through associations. Older buildings are raising concerns about reserves, maintenance, inspections, and potential special assessments. And suddenly, the condo that looked like the practical compromise is starting to look like an expensive question mark. That is why this story matters. Condo markets rarely collapse all at once. They weaken in layers. First, buyers take longer to commit. Then sellers start cutting prices. Then listings pile up. Then one building gets a reputation for high dues, another gets hit with repair issues, and another starts losing buyers because the monthly cost no longer feels justified. By the time everyone agrees the market has changed, the leverage is already gone. And in California, that shift is becoming easier to spot. This is not a list of the worst cities in California. It is a list of cities where condo owners may be facing the fastest pressure from affordability problems, slower buyer urgency, HOA fatigue, and a growing disconnect between what condos cost and what buyers are still willing to pay. So today, we are counting down the top 10 California cities where condo prices are crashing fast. Or at the very least, where the warning signs are flashing bright enough that every owner, buyer, and investor should be paying attention. And stay with me all the way to number 1, because the city at the top of this list may be the clearest example in America of what happens when urban condo living collides with rising costs, aging buildings, and buyers who have stopped assuming the upside is automatic. Let's get into it. Number 10, Long Beach. Long Beach makes this list because it represents a very specific kind of condo risk. A city that still looks attractive, still draws attention, but is becoming harder to justify once buyers run the monthly numbers. On the surface, Long Beach still has a lot going for it. It offers coastal access, walkability in certain pockets, downtown energy, and a price point that has historically looked more reachable than some of California's pricier beach markets. For years, that made condos here feel like a logical move for first-time buyers and lifestyle-driven buyers alike. But that same buyer profile is exactly why the city is vulnerable now. Long Beach condo buyers are often payment-sensitive. They are not always luxury buyers who can absorb every extra cost without hesitation. They are buyers doing real math. And when the mortgage is high, the HOA is high, and the insurance picture feels uncertain, the condo can quickly stop feeling like the affordable coastal option it once was. That is the problem. Once the emotional pull of location gets replaced by a hard look at monthly carrying cost, the sales process changes. Buyers become more selective. Units sit longer. Sellers lose urgency on the other side of the table. And in a market like Long Beach, even a modest slowdown can spread quickly because so much of the condo demand depends on affordability still feeling believable. That is why Long Beach is not just a city to watch. It is a city where the condo slowdown can move quietly, then suddenly feel obvious. Number 9, Pasadena. Pasadena is not the kind of place most people expect to see on a list like this, and that is exactly why it belongs here. This is a city with prestige. It has beautiful streets, a strong identity, excellent architecture, and a reputation that usually gives buyers confidence. Why condos in Pasadena have long benefited from that image. They offered access to a desirable part of Los Angeles County without requiring buyers to stretch all the way to a single-family home. But in a softer environment, image alone does not carry the deal. Condo buyers in Pasadena are becoming more skeptical about the parts of ownership they cannot see in listing photos. They are thinking about reserve strength. They are thinking about old roofs, aging systems, deferred maintenance, and whether the association may need to raise dues again next year. They are thinking about whether a beautiful building is also an expensive building hiding future problems. That matters because condo weakness does not always begin with ugly buildings in weak locations. Sometimes it begins in good markets where buyers simply stop believing every premium is justified. And Pasadena is especially exposed to that shift because expectations have been high for so long. Owners expect the city's reputation to protect value. Buyers expect quality. But if buyers start feeling that the unit itself comes with too much uncertainty, then the brand power of Pasadena cannot do all the heavy lifting. That is when prices start slipping, not because the city became undesirable, but because the condo value proposition became less convincing. Number 8. Oakland. Oakland belongs on this list because condo softness here can get magnified by perception. For years, Oakland condos were marketed as the practical Bay Area alternative. They gave buyers a way to stay connected to the region without paying full San Francisco prices. That story made sense when people believed they were still buying into broader Bay Area momentum. But in 2026, buyers are asking harder questions. If a condo still comes with a significant payment, plus HOA dues, plus uncertain future building costs, then the old relative affordability argument starts to weaken. Buyers begin comparing risk, not just price. And once risk becomes part of the conversation, Oakland condos can lose momentum faster than expected. There is another challenge here. Sellers are not just selling a property. In many cases, they are selling the buyer on the entire city narrative at the same time. In strong years, that is manageable. In cautious years, that becomes harder. A hesitant buyer is already worried about monthly costs, resale potential, and whether the building will remain attractive a few years from now. If they also feel unsure about location perception, the condo becomes even tougher to move. That is why Oakland is vulnerable. Condos do not need a dramatic crash headline to feel pain here. They simply need buyers to become more selective and less willing to take the leap on a property that no longer feels like the obvious value play it once did. Number 7. Los Angeles. Los Angeles is one of the clearest examples of how scale can intensify a condo slowdown. There are condos everywhere in LA. Different neighborhoods, different building ages, different HOA structures, different levels of quality, and no shortage of competition. In a hot market, that variety helps. In a cautious market, it becomes brutal. Because when buyers slow down in Los Angeles, they can shop endlessly. A building with slightly higher dues gets passed over. A unit with outdated interiors gets ignored. A property with weak reserves or signs of future repairs gets pushed aside for something cleaner, newer, or simply better priced. That creates a harsh comparison environment where sellers do not just compete with the market. They compete with dozens of nearby alternatives that may look safer or cheaper month to month. And that is the core issue in LA right now. The condo used to be sold as the reasonable path to ownership in a city where detached homes felt out of reach. But once you stack the mortgage, taxes, insurance, parking fees, HOA dues, and maintenance risk, reasonable becomes a lot harder to defend. The city still has demand. It still has global appeal. But condo demand here is less forgiving than many owners expected. In a giant market like Los Angeles, once buyers realize they have options and time on their side, price weakness can spread fast. Not because nobody wants to live there, but because nobody wants to overpay for compromise. Number 6. San Diego. San Diego proves that even a premium coastal market is not immune from condo pain. This city still sells a dream. Ocean access, strong weather, a laid-back image, desirable neighborhoods, and a lifestyle that people across the country still want. For a long time, condos in San Diego benefited from that demand because they offered entry into a market that felt almost impossible through detached homes. But premium markets are not protected when the monthly math stops working, and that is exactly where the pressure is showing. Buyers are increasingly asking whether the condo is truly worth the total cost, not just the sticker price. Are the total cost, HOA dues, insurance exposure, future repairs, association health, potential assessments, all of it. That is what changes the psychology of the deal. A buyer who once would have stretched for a San Diego condo because of location is now more willing to pause, compare, negotiate, or wait. And when buyers stop chasing, premium markets can soften faster than sellers think, because expectations were priced for confidence, not hesitation. San Diego is also vulnerable because many of its most desirable condo pockets compete on lifestyle first. That works beautifully when buyers feel secure. It works far less well when buyers feel financially tight and begin demanding a better balance between aspiration and value. That is why San Diego makes this list. The city still looks strong. The listings still photograph beautifully, but a beautiful listing does not automatically beat a heavy monthly payment. Number 5. Newport Beach. Newport Beach is where condo weakness becomes especially interesting, because luxury buyers do not behave the way many sellers expect. At first glance, you might assume high-end markets are insulated. Wealthy buyers still have money. Desirable zip codes still attract attention. Waterfront prestige still matters. And all of that is true. But luxury buyers are often incredibly disciplined when they sense weak value. Condo and attached living in Newport Beach can get stuck in a narrow lane. They are too expensive to win on affordability, yet they do not always offer the privacy, control, or long-term comfort of a detached luxury home. That means the product has to justify itself through lifestyle, convenience, and status. The moment buyers start seeing high dues, uncertain future costs, or softer resale potential, the shine starts to fade. And at this price level, buyers have alternatives. They can buy detached elsewhere. They can wait. They can hold cash. They can simply decide that shared wall luxury with recurring fees is not the best use of their money right now. That puts condo sellers in Newport Beach in a dangerous position, because the buyer walking away is not walking away due to inability. They are walking away due to preference, and preference shifts are hard to fight. That is why Newport Beach ranks this high. In luxury condo markets, prices do not have to collapse citywide to create pain. They just need buyers to stop accepting the premium without demanding a discount. Number 4. West Hollywood. West Hollywood is one of the most condo-dependent identities in California, and that makes it especially exposed when buyer enthusiasm cools off. This is a market built on location, image, social energy, walkability, and access. People buy here because they want to be in the middle of something. In many cases, the condo is not just shelter, it is part of the lifestyle brand. But lifestyle markets are vulnerable when buyers become more practical. The problem in West Hollywood is not that people stopped liking West Hollywood. The problem is that admiration does not always translate into willingness to absorb high monthly ownership costs. When the HOA is large, the mortgage is large, and the building itself carries future cost questions. Buyers start demanding more than just a cool address and a polished lobby. That is when pricing power slips. In a market like this, condos were often valued on the assumption that demand would remain emotionally driven. But 2026 buyers are colder. They are more analytical. They are more willing to push back. They want evidence that the building is solid, the dues are justified, and the resale story still makes sense. If they do not get that comfort, they wait. And once a city this dependent on attached living loses urgency, the correction becomes visible quickly. Price cuts show up. Time on market stretches. Sellers compete harder. And the exact qualities that once made West Hollywood feel bulletproof start to look less powerful against plain old financial skepticism. Number 3. San Jose. San Jose lands near the top because it shows what happens when a market built on future upside starts losing that certainty. For years, many buyers accepted difficult compromises in San Jose because they believed Silicon Valley appreciation would reward them later. Smaller space, less charm, higher cost, more density. It all felt tolerable because getting into the market was seen as a strategic win. That logic is weaker now. If appreciation no longer feels automatic, then the condo gets judged much more harshly in the present. Buyers start asking whether the monthly payment is too high for what they are actually receiving. They start looking harder at HOA structure, building quality, long-term resale, and whether a condo still functions as a true stepping stone. And that shift matters in San Jose because the city's condo appeal has always been tied to access. Access to jobs, access to the tech economy, access to one of the wealthiest regions in the country. But access becomes less exciting when ownership comes bundled with a heavy financial burden and no guarantee that the next buyer will be as eager as the last one. This is why condo softness in San Jose feels important. It suggests that even in one of America's strongest economic corridors, buyers are no longer willing to pay any price just to get a foothold. When that mindset changes, condos are often the first product type to feel the pressure. Number 2. Santa Monica. Santa Monica sits at number 2 because this is where prestige and condo vulnerability collide in a very visible way. This has long been one of the most aspirational coastal markets in California. Buyers were not just purchasing square footage, they were buying ocean air, walkability, image, and one of the strongest lifestyle brands in the state. Condos thrived here because they provided a way to participate in that world without paying full single-family home prices. But the key phrase there is participate in that world. When the cost of participation becomes too high, the value proposition gets shaky. Santa Monica condos were never sold as cheap. They were sold as worth it. And that is a much harder promise to defend in a market where buyers are closely tracking dues, insurance costs, maintenance exposure, and building risk. Once those concerns become central, location alone cannot protect pricing the way it used to. That is why a premium city like Santa Monica can experience real condo weakness, even while remaining highly desirable. People still want to be there. They just do not want to inherit too much cost uncertainty in order to do it. And when enough buyers start thinking that way, momentum reverses fast. Sellers wait longer, discounts deepen, buildings start competing against each other instead of benefiting from the city's halo. That is when a prestige market becomes one of the most painful places for condo owners who assumed the brand would always carry the value. Number 1. San Francisco. And at number 1, it has to be San Francisco. Not because every corner of the city is falling apart, not because detached homes and condos are telling the exact same story, and not because the broader housing narrative is universally weak. San Francisco ranks first because it may be the clearest example in the country of how the condo market can break away from the single-family story and become its own problem. This city helped define the modern urban condo dream: dense living, a walkability, sophistication, great restaurants, career access, a premium address in one of the most famous cities in America. For years, that image carried enormous pricing power. But now buyers are asking a much more uncomfortable question. What comes with the unit? And in San Francisco, that question can get very expensive very fast. High HOA dues are already a major hurdle. Older towers and aging mid-rise buildings raise concerns about maintenance and capital needs. Insurance pressure has made associations more cautious. Reserve issues can scare buyers. Compliance, repairs, and special assessments can turn a prestigious address into a financial liability overnight. That is what makes this market so dangerous for condo sellers. The product itself has become more complicated to trust. And once trust weakens, leverage disappears. A buyer walking into a San Francisco condo today is not just evaluating the kitchen, the view, or the location. They are evaluating the building's future. They are asking whether dues will keep rising. They are wondering if a surprise assessment is coming. They are trying to calculate not just whether they can afford the purchase, but whether they want to inherit the structure behind it. That is why San Francisco is number 1. It is the most symbolic, the most layered, and arguably the most revealing condo story in California right now. Because when a city that once represented the peak of urban condo aspiration starts making buyers nervous, it tells you the issue is no longer cosmetic, it is structural. And that is the real warning for California. The condo slowdown is not just about one city, one building, or one bad month. It is about a changing buyer mindset. People are no longer willing to overlook high dues, uncertain insurance costs, reserve weakness, or future assessments just because the location sounds impressive. They want value. They want clarity. They want financial predictability. And in many California condo markets, those things are getting harder to deliver. So if you own a condo in one of these cities, the message is simple. This is a market where presentation, pricing, and building quality matter more than ever. If you are a buyer, the message is just as important. Do not just buy the unit. Study the association. Read the HOA documents, understand reserves, ask about insurance, ask about upcoming repairs, ask the uncomfortable questions now because the biggest condo risks are often the ones you do not see on the first showing. And if you are just watching the California market from a distance, keep your eyes on condos. Because condos often show stress before the broader housing market admits anything is wrong.